Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate and tax expert Nik Patel. Now, Nik is a seasoned CPA and the principal of Patel Tax and Advisory. His specialty niches are in hospitality, franchises, restaurants, and real estate, but Nik also focuses on fractional CFO services for small and medium sized businesses, as well as comprehensive tax advisory. Now, in addition to his tax profession, Nik also has an investment portfolio that consists of parking garages, self storage, multifamily, and other miscellaneous commercial real estate assets. And so, guys, without further ado, I'd like to welcome Nik Patel to the show. My friend, how you doing today?
I'm doing great, Kevin. Thank you so much for having me.
Excited to have you here. And as it's funny, as we were chatting, I just realized that you're kind of in my backyard, not necessarily, but in the Tampa Bay area. So we're across the bay from one another, I guess you could say. So in the general areas. So excited to have you here, my friend, and excited to talk shop and learn about what it is you do and speak tax strategy. To all those that are tuning in that you're either actively investing in portfolio in real estate today or looking to get involved, but just need to learn a little bit more about necessary, path they need to take to ensure that they're making the right decisions around tax strategy, which is a big piece of the investment puzzle. So with that, I gave you that brief introduction, Nik. I know there's a lot more to your background and your story, so maybe let's start there. For those that aren't aware or don't know who you are, tell us a little more about yourself.
Yeah, well, that was a great introduction, so thank you. My name is Nik Patel. I started my firm about 10 years ago. The name of my company is Patel Tax and Advisory. And when I started my firm, I really wanted to focus on a niche that interests me and really works with the background that I have, and which is why we concentrate in hospitality, franchise, restaurants, and real estate. And part of our advisory is that we don't just go and show what we do from a tax perspective, but we help our clients with just general wealth building and how it can mix into tax planning, right? So one of my passions and that I do on the side is that we invest in syndications,
Mhm.
whether it's a parking lot or multifamily or whatever it is, and then we show how we can make it a benefit not just for your general wealth, but also for your taxes.
Yeah, no, fantastic. I know we're chatting about that earlier. I mean, ultimately, like your professional career, what you do day in day out is running your tax advisory firm, and so it leaves not too much time left over, right, to actually get out there and go purchase a multifamily property or a parking garage and actually be the one that's running it. So, which is where syndications really come into play. And the majority of our investors are professionals like yourself that either own their own business or just high income earners in general, and they're pretty darn busy with their own profession, whatever it might be,
Yeah.
and they're just looking for uh, more passive ways to get involved and actually own real estate and all the benefits associated with it, but don't necessarily have the time or inclination to actually get out there and do it themselves, right? Because they're focusing on what they're really good at, which is whatever business or professional career that they're involved in. So, no, that's fantastic. Appreciate that feedback there, and I guess maybe just a little bit more about your company. I know I'd mentioned in the bio that you also offer fractional CFO services. I guess more specifically, what does that look like? And then typically, at what stage is a business in? What size and what stage is a business in that would ultimately benefit from fractional services such as that?
Yeah, so a lot of the fractional CFO services that we offer are more on the high-end restaurants because
Okay.
a lot of the restaurants we focus on providing a lot of weekly reports, and not just weekly reporting to provide them with certain KPIs, but we also provide them with budgets, forecasts, uh, constantly monitoring their KPIs, looking at cash flow management, and we provide these reports so management can make decisions on a monthly basis or a weekly basis, depending on how frequently they need it. So normally, when they actually need it is once they start scaling, right?
Mhm.
If they start, many restaurant groups that we have, they want to just stay a certain size, and sometimes they manage their finances through their cash account. Now, that's one way to do it, but as you start scaling, it's going to be extremely difficult to do that. So by offering the services that we do, we can help them scale and just alleviate some of those burdens on the bookkeeping or cash flow management, so they can concentrate on growing. So I would say that if they get to at least 3 locations, once you start going beyond that, then our services become even more valuable.
Yeah. And at what point in time do they outgrow those types of services? What point in time is it? Maybe it's a top line revenue number, maybe it's a number of locations. I mean, I guess we could speak specifically to restaurants because that's kind of the niche that you focus as it relates to the fractional services. But at what point in time do you say, hey, like guys, like I've helped you get here, you're doing phenomenal. You got the foundation. You got the foundation in place, but you really need somebody, full time now. Like literally, I'm stretched. I don't think I can get you past this pivotal point. You need to bring someone full time in house. Is there a certain critical moment that you've identified that's typically when that happens?
Yeah, once they start getting into, when I would say at least, yeah, it's mostly on the time side
Hmm.
and how much, depending on the amount of locations, because we can have some restaurants that only do about $1 million a year, but they have a ton of them, or they may be 2 or 3 locations, but they're doing $3, $4 million a year.
Yeah.
But they both still need the same level of service. Uh, at some point, they will need a controller in-house. That's something that you typically build onto. We've had clients that actually build, to go back to in-house bookkeeping and try to recreate the model themselves, but then they find out that they can't replicate the process that we created because we have a global team. And by having a global team, we can actually keep the cost lower. So it always makes sense for them to use us in almost any capacity. But once they start going into areas where they constantly need to communicate with a bank or constantly need to communicate with investors, if they have any, then you start needing to, you maybe need a controller, you maybe need a
Yeah.
CFO. And then we act like more of a supplement.
Got it. Got it. No, that makes sense. So let's talk about syndication. I guess more specifically, I would love to hear from your perspective. I kind of gave my perspective, but from your perspective, just how you weave that type of investing into your advisory services to your clients. I mean, what does that look like? What are some of the benefits from your perspective that you share with them of why this would be something that should be a part of their investment portfolio?
Yeah, so this is actually one of my favorite subjects because it's just a passion that I do for myself, and then it's something I teach for the clients as well. The first thing is you have to be in the right stage to do it. As you know, you have to be. I wouldn't recommend it. I mean, you have to be. I wouldn't recommend it unless you're an accredited investor. Of course, you have to sign off on that. There's certain requirements you have to meet, such as income or assets or both or just one of them. And once you get to the level where you say, hey, you have enough financial feasibility to start investing, syndications make a great investment because it's outside of stocks, bonds, and mutual funds, the returns on syndications and the right asset class at that time can outperform those types of markets. The other thing is you never want to, just like stocks, don't put all your money into one syndication. Diversify it out, and also do it and stagger them as well. Is if you do say 100,000 this year and then 100,000 next year, well, the depreciation benefits from one property can start offsetting the income from another property, and then you can start playing this game where you're netting losses from one property to the other property. And the best part about it, you don't have to qualify for reps. Because
Hmm.
Kevin, like you were saying earlier, everyone has their own specialty. Their time is going to be invested in better focus into something else. So if we can have a hands-on approach like syndication, where it's really truly hands-off approach, you're just collecting those checks every month and still building wealth in the real estate game.
Yeah, I want to back it up a little bit. I don't want to leave anybody out. And let's. I would love if you could, Nik, maybe you provide some additional context on reps or real estate professional status, what that means, how those individuals are treated differently, what it takes to obtain that status. Again, just for those that might not be aware of what that means.
Sure. So when I say reps, that's short for real estate professional status. There's really 11 trades or businesses that you can participate in to qualify for this rep status. In order to qualify for reps, there's 11 categories. Just to say them really quickly, It's development, redevelopment, construction, reconstruction, acquisition, brokerage, management, operations, and I think I might have left out a couple. So if you're operating in those types of trades of business, you have the potential to fall under a rep status. So under reps, in order to qualify under reps, there's some other criteria as well. The first thing you have to have is a minimum 750 hours, and you have to have more than 50% of your time devoted to this type of trade of business. Once you get into that, now you qualify for reps. Now that's one part of the code to help get benefits from other started real estate, but that's just the first part. For me in my profession and a lot of the clients that we have, we don't fall under that category, which is why I kind of go under the plan B of investing, which is what we also teach. But if you are in reps, you have the benefit of claiming some of this depreciation as long as you materially participate in that activity to get these depreciation deductions. And what's great about it too, if you're married, you can use the income from, but you can offset the income from, say, your spouse, who may be, if they're a high income earner,
Hmm.
versus someone that's in the trade of business who's the other spouse. You can start netting them together, and that's when you start seeing the power of depreciation and real estate investing. And there's no other industry that can do that besides real estate.
How many sin? I know there's no exact answer to this question. I was always curious about, and some people playing the gray with, with obtaining that status. I never suggest doing that. Obviously talk to your tax advisor
Certainly.
on obtaining the right guidance. But, I guess speaking to somebody that maybe has investments in a dozen or two or three dozen different real estate syndications, right? Like now they're not actively in the in the trenches. They're not doing the day to day, but at some point it takes quite a bit of time to manage a fairly substantial portfolio, even if it is 100% passive, right? And so I'm wondering if there's a certain point to where one could justify that status, the amount of time they spend on their portfolio, even if the majority of their investments are passive, like syndications, like we're speaking to. Any thoughts there?
Well, you still have to, in order to remember to get under rep status, you have to fall under one of those 11 trades or businesses. But if they have a portfolio that big to where they can just live off of that income, well, then you may not need to qualify on the
Yeah,
reps,
true, true.
because now you have a huge portfolio, and most people like myself, you're constantly reinvesting into newer syndications. So as you
Yeah,
constantly invest, the depreciation starts offsetting the stuff at the beginning.
yeah. Yeah, well, let's talk about your plan B. Again, you mentioned that the majority of your clients don't, don't necessarily fall underneath that rep status. And so what does plan B look like for them? What's the advice that you provide?
Yeah, so the first thing is the way the code's written, the Internal Revenue Code, it's really, if you look at the way it's written, it's meant and encourages to constantly invest. So by constantly reinvesting in the syndications, and every time you invest in real estate, there's naturally going to be some sort of depreciation benefit, because most syndications know about doing cost segregation studies and what tools are out there to lower income. And because most syndications do this, that's where the power of depreciation really kicks in.
Mhm.
And even though it's passive, yeah, you don't get it immediately. But as cash flows starts coming, whether it's through a preferred return or whatever it may be, those depreciation starts offsetting the income once they do start generating.
Mhm.
So as it starts generating, you basically get cash free stream of income. So I mean, it's as long as you keep doing it, you're going to see the compound effect of the depreciation as well as your wealth building. And what's nice about it, you can build a portfolio with tax-free income that you've been getting
Mhm.
quarter over quarter or however often the syndication pays out.
Given that different types of real estate, you talk about cost seg studies and I guess speaking to the tax efficiency, some asset types are way more tax efficient than others. For example,
Yeah.
multifamily property is going to be more tax efficient than a parking garage, like a concrete parking structure. Mobile home parks, will argue that, are probably one of the most tax efficient of all of them, and RV parks, things along that line. But I guess what does that advice look like? I mean, do you go that granular with your guidance? Like if you're going to get them and, suggest that your clients, like, help take them down the road of investing in different syndications, do you get as granular to look at the specific asset types and the tax benefits associated with each and which one might be best suited for their individual needs?
Well, that's a good question, and it's kind of a tough question because I will say at the same time, we're not licensed financial advisors or investment
Hmm.
advisors, but we do provide guidance on which ones can provide you more depreciation than another one. Like you hit the nail on the head when you said, garages might not be as beneficial as say, an RV park or maybe a self-storage unit. Uh, so we don't. Another factor is also who are the sponsors behind these deals, right?
Hmm.
There are certain variables that you have to look into. What's the track record of the sponsor? Have they exited many projects? How long do they typically keep these projects for? So these are all things that we have to consider, or the investor would have to consider when they invest, because the timing of these things also play somewhat of a critical role in investing. We can get granular, but at some point we have to say, ultimately you have to make the decision
Yep,
because the benefits are different across all asset classes.
that's right.
But anything real estate, I tell you though, it's going to be no most times than not, it's going to appreciate.
Yeah. What's your crystal ball say about, we got the new administration in place, and what's your crystal ball tell us about, bonus depreciation coming back in full swing?
Well, here's the good news. Trump is a huge real estate guy,
Yeah.
right? I mean, when he was elected his first term, a lot of the changes he made, like the Tax Cuts and Jobs Act, were actually geared towards real estate. So I think real estate is going to be, uh, I'm not that part of the crystal ball, I would say is going to look pretty good. As far as depreciation go, again, he's a big real estate guy. It would not surprise me if they come back with 100% depreciation and make it retroactive.
Hmm.
I can't say that will happen, but when you have a conservative administration, it's a conservative Congress, the chances are higher than normal that it
Yeah.
could come back and it could come back hot and heavy.
Yeah, yeah, no, I'm crossing my fingers for it. It's obviously always, topic of conversation, especially now that he's, back in office. So, again, be a beautiful thing if it happens, but not the end of the world if it doesn't. Nik, for
Yeah.
those that want to learn more about you and your services that you offer, where's the best place to track you down?
Yeah, so we do have our most active social media is on LinkedIn. We have our website, cpapta.com. And in there, we offer a free discovery call for 15 minutes where we just get to know each other, see if we can work well together. And we just talk for 15 minutes. And from there, we can go into advisory, or sorry, not advisory, a comprehensive consultation. And this is where we take a bigger dive into their financial picture. And then from there, we can go on into advisory based on how the initial consultation goes. So back to the question, LinkedIn and our website.
All right, fantastic. Well, Nik, I appreciate you coming to the show. It's been a pleasure catching up and speaking with you, and looking forward to staying in touch. So, thank you.
Thank you so much, Kevin. Thanks for having me.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.